Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. April was an extraordinary month for markets with huge swings off the back of Donald Trump's tariff announcements. So where are we at now? It's confession season on the ASX and there are a growing number of companies telling investors that earnings and or revenue might not be quite what they had hoped, often on the back of the US trade war. Remember, this is general information only and you should seek professional advice before making investment decisions. Matthew Kidman is the principal of Centennial Asset Management. Matthew, welcome back to Fear and Greed.
Thanks, Sean.
Before we go further, Matthew, you have donated very generously to the Fear and Greed Royal Far West Ride for Country Kids fundraiser. Geez, there's a lot in that, isn't there? Thank you very much for that.
How far are you riding, Sean? Just remind me.
380 kilometres, and I'm in all sorts of trouble. 2 weeks to go.
Because I was just thinking maybe what I actually donated was not enough because it's going to be pretty tough. It could be hard out there. It could be wet. And a lot of rain up north.
Yeah.
You're not going to enjoy it. There's going to be a lot of swearing.
Yeah.
It's been dry down south. You should have gone down south.
We should have. No, I don't know. Anyway, Matthew has donated very generously, so thank you very much for that.
My pleasure. Good luck with it. It's in all seriousness. I hope it goes well.
Yeah, I hope I make it.
And well done.
Thank you. The last month in markets, what do you make of it? And I really want to get to confession season. What are we seeing coming up at this time, which is, a couple of months before the end of the financial year, and corporates kind of know where they're going to land? Yeah,
it was a wild ride, wasn't it? I can't remember when we last spoke, but we peaked about in the middle of our last reporting season, which was February. And it all came around the original tariff discussion, Mexico, Canada, and fell, and then kind of had the last shuddering kind of fall after Trump. I'm not going to mention what he named the day because that sounds like he was celebrating.
Yeah.
But when the tariffs went on all the countries, reciprocal tariffs, and it had that last lurch down. And then since then we've seen the Americans kind of slowly back away step by step from what they said, because I think they spooked themselves about how negative markets were. And the markets have responded incredibly well since then. The Australian market's, comfortably above where it was on that April 3 or April 4, whatever it was in Australia when those tariffs were announced. So it's quite amazing. But as you say, we're starting to enter the new phase of the market, which we've had the US first quarter for them, reporting season, and they're a fair way into that now and been going most of April since those tariffs were announced. And now Australia hasn't got an official third quarter as it is for us because it's got a different balance date, June 30. But we do have what we call a bit of a confession season. And of course, we've got the famous Macquarie conference next week, which is probably the biggest conference in Australia for companies. And we'll get a raft of updates then, we would think. And so that'll set the tone going forward.
Notwithstanding we've got Macquarie coming up, what's the general gist coming out of corporates around tariffs, Aussie corporates?
Yeah, so Australia's not in a bad position, as we know. We've got this 10% tariff, but we don't do too much trade with the US directly. So domestically, we're okay. But of course, over the years, a lot of Australian companies have got exposure to the US. And because that's been the growth avenue for many companies and been successful. But so we're seeing real signs from our companies that things are slowing down, especially for the consumer. So it's bled from, say, US airlines into other companies in Australia. Of course, we've had 2 downgrades from two of Australia's biggest travel groups, corporate travel, just, this Friday just passed. And we had before that Flight Centre. Everyone kind of expected it, but it was really sharp, quite meaningful downgrades around travel in the US, which is one of the first things to fall off with consumer confidence, and probably a bit of a harbinger for what's going to happen over the next 3 or 4 months. Even more damaging was a little company called Tourism Holdings, THL, which depends heavily on European customers that go around the world and hire recreational vehicles to travel around for 4 to 6 weeks. The numbers out of the US were down 45, 50% for this summer coming. And so that's hit them for 6 because they take forward bookings because it's not, we're flying the equivalent to, New York to Washington. This is, let's plan a 4 or 6 week holiday, which they do earlier, and they've been hit already. So the US exposure, especially for certain services has really dropped off and it's been nasty. Some of the updates here have been a bit mixed. We're going through in the domestic economy. We had an unusual holiday period during April, and then we've had the federal election. So that's going to take the shine off most things just because of the nature of those periods where spending, not because we're in a funk or anything, but spending just tapers off. I'm actually quite bullish, Sean, on domestic Australia. We've just got through the election, and that's a good thing. That we're always apprehensive, just the unknown.
Mm-hmm.
And then we've got a Reserve Bank board meeting later this month in May, which everyone's tipping an interest rate cut. Inflation's back in a reasonable zone. We've got the prospects of goods, and this is where the tariffs might work for us, goods coming out of China being redirected around the world that are not going to America now. So that could be quite good for pricing for goods, especially cars, as we know, coming into Australia. And I suspect that maybe given the tariffs and the world growth picture, which has come off a bit, everyone's down, forecasting slower growth around the world, especially out of the US, might lead us to more interest rate cuts as we travel through the year. And that would help the domestic situation because we're not getting hit so hard by the tariffs.
Okay, I want to talk international in a moment, but we're going to take a quick break. Stay with me, Matthew. I'm talking to Matthew Kidman from Centennial Asset Management. When you look overseas, and let's start with the US and Wall Street, particularly the tech stocks, we've had some really interesting results over the past week or so. Microsoft, Meta, Amazon, kind of mixed results, I suppose.
Yeah, that's right. Obviously, Microsoft surprised the market with a good result. Amazon, not a bit mixed, and some of we were talking about it during the last few days as the results come out. The chip makers mixed, and we'll get Nvidia's always a bit later. That's the big one.
Yep.
So it's got to kind of choose your poison there. Mm-hmm. But the tech companies are probably holding up reasonably well compared to. I think that the risk in the US at the moment is around the consumer, and that will bleed into business confidence and capex related, so that more industrial business to business kind of model that will flow in. As you know very well that recessions or slowdowns take a while to hit the actual numbers in terms of employment. But what we have with this one is we know that port volumes are really coming off in the next week, which is interesting. So goods coming from China into the US are coming off dramatically over the next week or so. We've already seen some people laid off around transport, and that will hit the shelves, and that's a big problem. The tech companies, on the other hand, are probably okay for the moment, but like everyone else, eventually they will feel a slowdown.
It is remarkable that port data, how quickly the tariffs have affected movements of goods. It just seems almost instantaneous.
Yeah, so I think what's happened to a lot of goods is that the consumers in America, because of the price hikes, have just cancelled orders, full stop. Just can't afford it. There's no margin in it. They're going to lose money on it. Rather have nothing on the shelf or nothing to offer than just lose money, because the consumer, when you think about it, something that might have cost $80 last time is now at $200 overnight. People are going to, that's big sticker shock. They're not going to, either the Chinese are going to have to take some of that margin, the retailer, but whichever way you cut it, everyone's going to lose. So it's just not going to work. So orders have been cancelled. That's why shipments are down. It's really tangible. You can almost see it working its way through the system. And Los Angeles Port are forecasting next week. It just happens to hit next week because of the way the delay on when ships leave China coming to the US are down over 35% next week from 1 week to the next. It's just bang. So it's going to affect everyone unless they can reverse it really quick. There's already an air pocket. No matter how quick they move now, it's already in train. It's going to take a while to reverse. And I think everything's going to slow down. There's consumer sentiment, as we call it, the soft data or the leading indicators are going to start to hit the real data in, say, the next week. And that will be the case And eventually you'll see unemployment start to rise maybe over the next 6-7 weeks. And so, it's a slowdown is on now in the US. And I think it's a dangerous place to be operating, even if you are a robust big tech company.
Matthew, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Matthew Kidman from Centennial Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before investing. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.